So, Williams-Sonoma just beat consensus across the board for Q2 2026.
Yeah, they really did.
I mean, non-GAAP EPS came in at $2.10, which topped the 203 to 208 estimates.
Right.
And revenue hit 1.96 billion, so that edged out the 1.92 to 1.93 billion expectation.
Exactly.
And management even raised their full year guidance. Like they bumped net revenue growth up to a range of 4.7 to 7.2% and lifted operating margins to, I think, roughly 17.8 to 18.2%.
Yeah, which is the classic beat and raise on paper.
Right. But then despite that clear beat and raise, the stock immediately slipped like 4 to 5% intraday, just dropped right back toward the $225 range.
An immediate sell-off, yeah.
So taking the Q2 earnings report and, the management commentary and analyst notes we have in front of us, the mission for this deep dive is to figure out why the market just completely punished what looks like a flawless quarter.
It is puzzling if you just look at the surface.
Because it feels like a marathon runner posting a personal best time, but the judges lower their grade because they realize they had this massive tailwind for the last 3 miles.
Right.
Like the market isn't looking at the finish time, they're looking at the fact that the wind is stopping.
That is the perfect way to look at it.
Mm-mm.
Because to understand why the market is worried about that wind stopping, you have to look past the top-line revenue beat.
Okay.
And you have to look really closely at their underlying margin compression.
Right, at the margins.
Yeah. Their non-GAAP gross margin actually fell 160 basis points down to 45.5%.
Oh, wow.
And the main culprit there is a heavy 230 basis point hit to merchandise margins. And that's coming straight from tariff costs.
Okay, wait. Let's unpack the tariff situation real quick because there's a massive anomaly in these sources.
Oh, yeah, the refund.
Right. Williams-Sonoma received a $200 million IEPA tariff refund.
Huge chunk of change.
Yeah, and they recognized $174 million of it in their GAAP results, but they entirely excluded it from their non-GAAP numbers.
Right, which makes the non-GAAP look worse in the short term.
Yeah.
But it's actually a much cleaner look at their true operating reality.
That makes sense.
And what's really fascinating is how they allocated that unexpected cash infusion.
Right.
Because they uniquely used a $47 million chunk to reimburse their vendors for past discounts.
Wow.
And then put another $10 million into funding employee 401ks.
Which, I mean, that's a brilliant move for long-term vendor relations and, employee retention.
Absolutely.
But I'm stuck on his raised guidance.
Yeah.
If management knows this tariff refund is a one-time cash injection and they know supply chain costs are sticky, isn't raising their full-year margin guidance incredibly risky? Like, how are they justifying that?
Well, that is exactly what spooked the market.
Really?
Yeah, their raised guidance assumes that current tariffs remain in place, but it completely strips out any future refund benefits.
Oh, I see.
So investors looked at that dynamic and realized the company is facing persistent supply chain and transportation pressures moving forward.
But they won't have another magical $200 million cushion to soften the blow.
Exactly.
So if margins are being squeezed that tightly by external costs, I have to ask, how is their revenue growing so well? Because the top line looks phenomenal.
This is where their quarter actually gets incredibly impressive.
Okay.
You have to contextualize this. The broader home furnishings industry was completely flat this quarter.
Like zero growth.
A zero growth environment, exactly. So Williams-Sonoma posting 6.2% comparable brand revenue growth isn't just a rising tide lifting all boats.
Right.
It is pure market share theft from their competitors.
Taking a look at the brand breakdown, it's pretty much across the board, too. I mean, the namesake Williams-Sonoma brand was up 7.6%. West Elm up 6.4%, and Pottery Barn up 5.1%.
Yeah.
And the B2B segment absolutely surged, up 14.5%.
Incredible numbers.
But again, how are they stealing this much share without crushing their margins further? Because usually, when retail sales jump in a flat market, it's because a company is heavily slashing prices.
Right. But management was very clear in their commentary about this.
Yeah.
This growth was driven by full price selling.
Really? No heavy discounts?
No, they didn't rely on promotional discounting to move units at all. Instead, they leaned into new brand collaborations and, crucially, their AI shopping assistants.
Oh, Olive and Auto.
Yes, Olive and Auto.
I read about these. They aren't just your standard, frequently asked questions chatbots, right?
Not at all.
So how are they actually moving the needle on revenue?
Well, they are drastically boosting conversion rates by acting like virtual interior designers.
Oh, that's cool.
Yeah, they don't just answer basic queries. They predict what furniture fits a user's specific room dimensions.
Oh, wow.
And they automatically bundle cohesive product sets. like suggesting the exact rug and lamps to perfectly match a sofa you're looking at.
So they're upselling customers seamlessly behind the scenes.
Seamlessly, yes.
So they are achieving this massive market share grab completely independent of any housing market recovery. Like they aren't sitting around waiting for mortgage rates to drop so people start buying houses and needing new couches.
Precisely.
Yeah.
But I will say they aren't totally out of the woods on costs.
Right.
Management noted that Q2 was likely the peak for those tariff pressures, but they are still facing elevated oil prices.
Which obviously directly impacts their massive transportation and delivery network.
Exactly. And looking toward Q4, they have a looming 150 basis point shrink accrual headwind that they have to anniversary.
And let's clarify that mechanism real quick. Shrink is essentially just retail talk for lost or damaged or stolen inventory.
Right.
So they're going to have to account for that shrink. And comparing those numbers against last year's unusually favorable metrics will artificially drag down their Q4 margins on paper.
Exactly. So the margin pressures aren't evaporating overnight, even if the top line is stealing the show right now.
Which actually brings us to a final thought I want to leave you with based on all these notes. Management hinted at massive future opportunities simply by improving their overall inventory accuracy. Because think about it. They have a massive $1.45 billion inventory.
Yeah, that's a lot of product to manage.
Right. So if these new AI tools can help them optimally manage that flow and actually expand their margins in a completely stagnant high interest rate environment,
Right.
just imagine the margin expansion that becomes possible when housing turnover finally recovers and the wind is actually at their back.
That's the real upside.
Yeah. Be sure to follow the show for our daily earnings coverage.